All right, today we're diving into a really fascinating corporate comeback. We're looking at Duty Free International, or DFI, and their latest numbers are, well, they're pretty wild. We're talking about a company that went from losing millions to making millions in just a year. It's a massive financial swing, and we're going to break down exactly how they did it. So yeah, that's the big question, right? How in the world do you pull that off? You see a company losing millions and then blink, they're in the black. Was it some kind of sales miracle, a brilliant new strategy, or was it something else, something kind of hidden in the fine print? Well, we're about to find out. Okay, first things first. Let's just look at the raw numbers. This is where you can really see the scale of this turnaround. It's the classic before and after shot, financially speaking. And here you have it. Just look at that. Last year, in the second quarter, DFIL was staring at a loss of 3.2 million ringgit. Now, fast forward 1 year, and they've posted a profit of 2.6 million ringgit. That's a total turnaround of almost 5.8 million ringgit. I mean, that is a huge recovery, and it really makes you wonder, where did that profit come from? Now, you're probably thinking, okay, their sales must have gone through the roof. And yeah, you're not wrong. Revenue did go up. It hit 42.6 million ringgit, which is a nice 14.5% jump. And the company says that's simply because more customers were buying things. And that's great. But an extra 5.4 million in sales doesn't quite explain a 5.8 million swing in profit. So that tells us the real story, the real hero of this comeback is hiding somewhere else. So let's put on our detective hats and dig a little deeper. We've got to look past the sales numbers and get into the nitty-gritty of their expenses. Because it turns out the key to this whole thing isn't just about what DFIL earned, it's about what they stopped losing. And boom, here it is. This chart tells you almost everything you need to know. Look at that bar on the left. Last year, DFIL had an unrealized foreign exchange loss of over 5 million ringgit. It was just a massive anchor dragging down their profits. Now look at this here. That loss shrank to just 189,000 ringgit. That is a jaw-dropping 96.3% reduction. This one thing, this single line item, accounts for nearly 4.9 million ringgit of that positive swing we saw. It's huge. So, what is this unrealized foreign exchange loss? Let's break it down. Basically, think of it as a loss on paper. It happens when a company holds a bunch of cash in, say, US dollars or Thai baht. If the value of those currencies drops compared to the Malaysian ringgit, then suddenly, that pile of cash is worth less. It's a loss. Last year, DFIL was holding about 93.5 million ringgit in foreign cash. This year, they cashed most of it out, holding only 14.3 million. By simply getting out of that position, they dodged a massive bullet. It was a really smart defensive move. But it wasn't just that one trick. DFIL was also playing some serious defense on its spending. They were disciplined. Employee benefits, down over 13%. Utilities and maintenance costs, chopped by almost 29%. And get this, promotional expenses were slashed by nearly 94%. So they weren't just fixing the Forex problem, they were tightening their belts everywhere, running a much leaner, more efficient ship. And all those savings, they went straight to the bottom line. Okay, so DFIL fixed the leaks and got the ship sailing straight again. You'd think they might just enjoy the calm waters, right? Nope. What's so interesting here is that they're using this newfound stability to make some huge, expensive bets on a totally different future. This is where the story takes a real plot twist. First up, this number, 175 million ringgit. Just let that sink in for a second. This isn't some small side bet. This is a massive investment that screams they're about to make a major move into a completely new area. So what are they buying for 175 million? A company that makes car parts. Yeah, you heard that right. A duty-free retailer, a company known for selling chocolates and perfumes, is jumping headfirst into the automotive supply chain. This is diversification on a whole other level. They're trying to build a completely new engine for growth that has nothing to do with their old business. And if you thought that was a big move, wait till you see this. We're talking about a project with a gross development value of nearly 500 million ringgit. So we've gone from a 175 million ringgit bet to one that's almost 3 times bigger. This is another massive leap into a brand new industry. And this bet is on property development. They're partnering up with Chin Hin Property to build over 1,200 serviced apartments and some retail shops in Johor Bahru. So let's recap. They're a retailer,
They're about to be an auto parts maker, and now they're also a major property developer. They are not just testing the waters here. They are diving into the deep end of two completely new businesses. All right, it's easy to get excited about this big turnaround and these huge future plans. But let's pump the brakes for a second, because DFile's own report gives us a pretty important reality check. The road ahead isn't all smooth sailing, and the company is being very honest about the challenges they're facing. I mean, this quote from their own Outlook statement says it all. They are literally telling everyone, hey, things are still going to be tough for our main business. This isn't them taking a victory lap. It's a very sober and realistic look at what's coming. So what exactly are they worried about? Well, they lay out a few key problems. First, costs are going up, both for the products they sell and just for keeping the lights on. Second, inflation is sticking around, which makes everyone feel the pinch. Third, because of that, shoppers are being a lot more careful with their money. And finally, they had to close a major store at Bukit Kayu Hitam, which is directly hurting their sales. So even with this great quarter, they're still fighting an uphill battle. So where does this all leave us? We've got a company that brilliantly fixed its finances by cutting costs and reducing risk. But at the exact same time, it's making these gigantic, company-changing bets on a future that looks nothing like its past. And that brings us to the final, really big question for DFile. When you boil it all down, DFile is playing two games at once. With one hand, they're trying to run their retail business as lean and mean as possible to survive a tough market. And with the other hand, they're taking the money and stability they've earned and throwing it at these huge new ventures in completely different industries. They're defending their current castle while trying to build two new ones on the side. And that's really the multi-million-dollar question, isn't it? Is this a brilliant strategy to create a stronger, more resilient company that can handle anything? Or, by jumping so far outside their comfort zone into these really expensive industries, are they taking on a risk that's just too big, one that could threaten the very stability they just worked so hard to get back? We'll have to wait and see. Thanks for tuning into this explainer.